Good morning, everybody, and welcome to this joint Bartier Perry and ESV webinar, where we'll be looking at directors' duties, stimulus packages, and potential consequences for businesses and directors in this COVID-19 period. Today, you will hear from initially Jason Sprague, who is a partner in our corporate and commercial team at Bartier Perry, and he will talk about some general issues to consider for directors. Following Jason, David Pritchard, who is a partner at ESV Business Advisors and Accounting, will say some words. David is a partner who provides general tax services for businesses and individuals. Following David, I will say a few things from an insolvency perspective. On your control panels, you'll see that you have access to handouts for each of the three presentations. And also there is a section in the chat section to ask a question if you would like the presenters to do so. We will deal with questions at the end. Without any further delay, I'll hand over to Jason to kick us off.
Good morning, everybody. Thank you for joining us. Thank you, Gavin. As Gavin indicated, I'll be looking at a general overview of directors' duties and how COVID-19 has impacted that. There's certainly been a lot of crisis management undertaken in the last few weeks. One of the concerns that people have is how do they make decisions in such an environment and what impact that might have in terms of their duties. So very briefly, in the short time frame that we have, we'll have a look at what's changed, the common areas of concern that are being raised in the current state of play, how boards have responded. Now, there are different ways in boards respond, and depending on the size of your organisation, often depends or drives that sort of response. At the end, there'll be a few take-home points for boards to consider in terms of discharging your duties going forward. So what has changed? In effect, nothing has actually changed. Your directors' duties are still required to be undertaken in the same manner as they did before COVID started. Yes, there's been some reforms and concessions, but not a free pass. Directors are still required to undertake their duties in the same manner, all care and due diligence, undertaking those processes which they have always had to do. Now, it's interesting that the reforms and concessions are being granted in specific areas where there's some greater concern, but they are only temporary. Most of them are 6 months, and they're only provided if certain conditions are met. Gavin's going to be speaking about the insolvency provisions in a little more detail at the end of the third speaker. But one of the interesting things in that area is if you are looking to seek relief, you have to prove you qualify for the relief, rather than being able to raise it as a defence and somebody actually say, no, you're not entitled to it. One interesting case that has recently been decided is the Storm Financial Services Appeal. That was a case looking at directors' duties and how Section 180 was applied. Interestingly, it was a case brought by ASIC, which showed that Section 180 has a public dimension. So it's not only shareholders who can bring these sort of actions. Now, while the case did say that directors are not obliged to ensure that companies do not break the law and have an action under that, if it was foreseeable the company might suffer loss and damage as a result of that breach, then there was a potential claim against directors and a breach of their duties under Section 180. Now, that's the current state of play. So in terms of how people deal with COVID-19 and discharge the director's duties, the decisions that are made today will have impacts potentially down the road, and you must try and undertake an analysis to see what impacts your decision will have on a company, what risks might arise. Yes, this is a very difficult situation in terms of what we've had to go through, in terms of all the information, the rapid speed of COVID-19 and the impacts that people have had to deal with. However, while it is difficult, it hasn't really changed the underlying state of play. So the areas of concern that we've seen with our clients, a lot of them are fairly common, they've been well ventilated in the media. I look at it in two categories, the commercial category and also a governance category. The commercial categories are fairly obvious. As the COVID-19 crisis emerged, workplace issues were very predominant. We've all had to deal with staff in terms of layoffs and stand downs, reduced salaries, reduced hours at work. Contractual obligation has been another big one, which our clients have been discussing in the early days. Can I terminate my contract? Is there a force majeure option? Is the contract frustrated? Now, these sort of things will continue to evolve as we go forward, as we enter into the new normal, whatever that may be. But one thing has been quite key in terms of the literature is that it's about relationship continuity. A reflex reaction to terminate a contract is probably not going to be in the best interest of the company. And this is again about looking forward, looking how your company will be placed and how that may impact the company in the future, all in discharge of directors' duties. The other ones there are also explanatory. I'm sure everyone's familiar with the commercial leasing code, which has been mandated to give relief to commercial tenants in terms of rent. There's been restrictions on evictions for 6 months, both at residential and in commercial settings, to always try and keep some degree of stability within the system. The debt issues, I think, were a good idea to raise the claim levels to 20,000 for both statutory demands and bankruptcy to again give some comfort and protection against those businesses in distress. The insolvency concerns I won't touch on. That's what Gavin will look at as our third speaker. For those of you who are in public listed companies, one of the big issues has been about continuous disclosure. Again, the fundamentals are unchanged. ASX has acknowledged there are difficulties, but rather than make any changes, they've simply highlighted the exceptions to continuous disclosure. The main one being that you don't have to disclose information if it's insufficiently definite. If there is nothing there to warrant disclosure because it's uncertain, you have a potential defence in not disclosing. Other commentators have said that's not particularly a good position because we have an information vacuum. How can the markets function appropriately? Given this uncertainty, which will continue, have been caused by bodies such as Australian Institute of Company Directors, the safe harbour securities class actions to prevent people making claims against directors for failing to disclose or inadequate disclosure. So to watch this space for listed companies, and it is an area which is going to continue to play out and be very challenging. Reporting obligations, our second speaker, Dave, will talk in more detail about some of these things. ASIC has released some guidance notes to assist with financial reporting and audits, looking at key focus areas, especially with write-downs and valuations for companies, but ultimately the fundamentals remain unchanged. Shareholder meetings is one area which has caused some concern for those companies who have a financial year ending 31 December, because they should be holding their board meetings now. ASIC did grant 2-month extensions and no action letters, which was to some degree welcome, but it didn't take away the obligation to have the meeting. However, on the 6th of May, the Corporations Act was changed, allowing all companies to hold their meetings virtually. Previously, if your constitution didn't permit meetings to be held virtually by electronic means, you couldn't do it. That impediment has now been removed, again for a 6-month period. But what this means is that there's really little excuse not to hold your meetings. So again, communication with shareholders, adherence to your obligations with meeting requirements, it's quite clearly unchanged. And if anything, it's being brought closer to comply with it rather than having an exception. The next part I'd like to talk about is board actions and the operations and the responses to COVID-19. There's been 3 typical responses of boards. There's no right or wrong to any of these, and often it's a function of what your business is like. Much larger organisations who have more sophisticated infrastructures and crisis management processes, it's almost business as usual. Now, the quotes here are from various CEOs, and for some people it's just BAU, we are continuing to do what we've always done. That's fine for large organisations to a degree, but it will depend as how your business is being impacted. Then there's another, I suppose the other end is where we look at organisations whose directors become highly engaged, become executives, undertake the work of management. Again, for smaller businesses where the directors are also business owners, this is almost required, given that they have to try and maintain an organisation's financial security by laying off staff, but still trying to keep the wheels turning. A classic example is the Young Henry's Brewery in Newtown, who essentially stood down all their staff, except for maybe 1 or 2, but the directors themselves have taken up the tools, with one of them working on the stills. But they're also, interestingly, pivoting, as a lot of alcohol makers have done, to create create hand sanitizer for the new market that's being created. But again, is that a right or a wrong response? It just depends on how your organisation is structured. For those who are sort of in the middle range, and this is where most of the literature is saying people should look at going, is to be adaptive and agile. There's a new reality of extreme uncertainty, which you have to adapt to, have to be mindful of. But at the same time, you need to let your organisation, your business continue to function. Their view is to let management do their job with board oversight, doing what it needs to do with guidance and information. What happens is there's an increased requirement for boards to meet. There's massive information flows in a very short period of time. So it is very demanding on boards, but at the same time, their role remains as a board to guide the organisation. So moving forward, we're coming off the peak of the crisis to some degree in terms of the immediate uncertainty, but that uncertainty is not going to go away anytime soon. It's going to be on a longer time scale. We're trying to work out what the new normal might be and prepare for that. And that's what you as directors have to do. As a board, you have to work out what that new normal is going to be, look for the information that's out there, try and guide the organisation through these difficult times. It's a challenging time. It's not easy to do what needs to be done, given there is so much uncertainty around. As I indicated before, there is no perfect solution, but one thing which you do see in a lot of the literature at the moment is about the decision-making process. Not just to focus on an answer and sort of dictate it from on high, but to make it an engagement process with all stakeholders in an organisation. In today's very connected society, that's more critical than ever. It's easy to have bad decisions publicised very widely, very quickly. Engagement with employees and all stakeholders is critical, and if information is provided, if people have bought into the reasons and understand the reasons, the risk of claims or claims of breaches of directors' duties are likely to be minimised. Again, in crisis, core values and beliefs are put under extreme pressure and testing. You have sold these core beliefs and values to your stakeholders. It's a time now to adhere to those, to create certainty in your organisation and to create belief. And those are some of the key things which will help guide a business forward. In conclusion, there's some take-home points. This particular slide was created by the Ethics Institute and was also reproduced in the Australian Institute of Company Directors May magazine. It looks at ethical considerations in the employment context. It's been a very difficult few weeks in that area, but these considerations are things which can also be applied to other decisions that have to be made. Now, as we move forward, a lot of issues which we've made stopgap measures on to try and stop the immediate bleeding will have to be addressed. So there will be further difficult decisions to be made down the track. How that will look will depend on how you respond, how you assess your situation, and how you engage with those stakeholders in your business. Other points for the board, key questions about your leadership, be a bit introspective, look at if you've got the right mix of people. How's management positioned? Are you preparing for the post-pandemic future? Are you preparing now for opportunities? Many larger organisations will have a crisis management team, but also a subcommittee looking for opportunities. With any crisis, that is opportunity that does come along. Things to avoid, don't be complacent. It's hard to be complacent in these times. I suppose a better view of being complacent is just putting your head in the sand and hoping it will all pass. Unfortunately, it won't. It's here, and decisions have to be made. Communication is the key, looking at how management is and supporting management. So as directors, your decisions, of course, have a key impact on the business going forward. Your duties have not changed. It's a difficult time. One of the key things is, of course, getting the right advice, talking to professionals, and looking at the right information. We're here to talk and the use of sounding boards if need be, and we're just a phone call or a click away on the emails. And with that, I'll finish my section and pass on to our second speaker, David Pritchard. Thank you for your time.
Thanks, Jason. Good morning, everybody. We will this morning just be talking through some of the key risk areas in relation to the JobKeeper stimulus package, and we'll look through some of the risk areas as a director and what that means. And just to put this into context, there are approximately 11 different pieces of law or guidance that's come out in relation to JobKeeper in the last 3 or 4 weeks. And even taking that into account, there is a distinct lack of coverage. There are exceptions, there are irregularities around how things are working. And to reiterate what Jason said around decisions and short timeframes, timeframes to make decisions to enrol or to enrol out of JobKeeper are time pressured. It's a prospective law, and you need to have all of your ducks in a row before you move forward. So the JobKeeper rules, despite what it comes across in the press, there's no God-given right to access those rules. The rules are there, but there are 3 fundamental hurdles. The first one is the turnover test, and that's where the ATO will be looking to assess eligibility in the first at the first point. The simple way to think of it, if you go back to your board games, which I'm sure you've been doing a lot at home at the moment, is if you do not pass your turnover test, you cannot pass go, and therefore you cannot collect your $1,500 per employee per fortnight. What does that mean? It depends, depending on which type of business you are. It could be a 15%, a 30%, or a 50% fall, but it's based on taxable sales from a GST perspective, and you have to have normally a 30% fall for most businesses. Importantly, the comparison is a historic position compared to an actual or projected position in the future. Now, that can create a number of difficulties around what is my projected GST turnover. So that's taxable supplies and tax-free supplies, or exports is the most common one. It excludes input tax supplies. So you need to be very careful in understanding what your turnover is. The ATO, in their guidance that they've put forward for how to calculate your turnover, provided law companion ruling recently, 2020/1, and that really gives you 3 different ways to calculate your turnover. There's the value of the supplies made, there's an accruals method, and there's a cash method. So for those of you that just thought, well, it just goes what's into my financial statements, that may or may not be correct, depending on how you account for things from a GST perspective, what sort of business you're in, how you make those supplies, whether those supplies are provided over time. So there's actually a lot of complexity around what is included in your turnover and what is excluded. In addition to which, the law companion ruling provided guidance around that you don't need to take into account the benefit of the JobKeeper payments when you're doing your projections. Why is that important? Well, if you're charging out labour or your turnover is a function of the labour time that comes into the business, then clearly if you included the JobKeeper, it would be a self-fulfilling prophecy, and therefore you wouldn't have the fall, or if you didn't, then you wouldn't. And so the ATO perfectly said you don't need to worry about that, which is useful to know. Importantly, what we have is to make a projected GST estimate. That can be on a monthly or quarterly basis, and there are certain intricacies that we need to be careful about when building those projections, because our projections, as you'll come on to see shortly, is where we live or die in relation to accessing these rules, and therefore whether the company that you're managing is entitled to keep and retain that money, or loses and has to repay that money with potential penalties and interest. Importantly, your turnover that you're projected to make and report to the ATO does not actually need to be your final actual turnover. The ATO accept that you're making a projection, that you can't guarantee what it's going to be, and the ATO will accept that there are variances between what you're forecasting and what comes in within reason. And the ATO's guidance in the law companion ruling is that if it's reasonable for them to conclude that your projection was right or was made on the right basis, and we'll come on to that in a second, then they won't seek to move forward with any potential review. However, if there's a significant difference between what you project and what comes in as an actual, then they are likely to raise questions and come back with a review. What's a significant difference? There is no guidance on that. So the ATO have been very, very clear that they're going to accept people's position as long as it's reasonable. However, they are going to be very careful about what they look at and how they can examine those positions. When you're building your projected GST turnover, you need to be objective in your assessment. You need to be reasonable. Whether you're going to derive income or make a supply is based on the probabilities. So if it's 60-40, it's in. If it's 40-60, it's out. What's your growth pattern been like? What are your contracts that are scheduled to be undertaken in this period? Have they been cancelled? Have they been amended? What are your likely sales going to make? All those things need to be included in and recorded and documented. That is really important, making sure that you have this documented. Failure to document your position will be a problem if you get reviewed, because there will be a denial of your entitlements. The forecasts are at a point in time. That means today I make a forecast, and I'm making a forecast today for the quarter to June. That's fine. It's based on the information that I have right now. Looking at the trading conditions, announced step downs of restrictions, what does that look like? So if you'd have made a forecast earlier on in the period, maybe you're more pessimistic than you are now. As you get later in the period for JobKeeper, having a more pessimistic outlook may be harder to justify if we're stepping back on those restrictions. The ATO have the benefit of hindsight, and where you miss that threshold and it's a significant miss, you are likely to get a review. However, if you've got your records documented, how you've calculated your projections, what that looks like, the terms and conditions, what notifications that you had from your clients, your customers, you were struggling to import stock, or you had issues around getting people to work for you. All those things need to be documented and put together as essentially as part of the defence package, part of your insulation package to having a review. If that's there and documented, then you'll be well placed to rebut any ATO inquiry. As part of this process, the ATO have also released a practical compliance guide, which is 2020/4. This is where the ATO are giving some guidance on where their compliance activity is likely to be directed. So if you've deliberately deferred revenue or accelerated revenue to create a dip in turnover so that you then access a particular period of a fall, so you've just accelerated invoices in a month in April so that in May that you fall below the 30% compared to the prior year, then they're likely to come and review you. Service entities, these are part and parcel of some of the changes that have come through in the last week or so, where the ATO have released the third amendment of the initial set of rules. In the PCG here, the ATO gives some clear guidance on some nice and easy scenarios where a service entity recharges only, really provides labour to other entities that do the external trading. The general guidance on this is that where your position is that you are economically impacted and you have a fall in turnover, of the trading entities, then they're likely to not employ a significant amount of resources towards dealing with you. If, however, you don't have a fall in economic turnover and you leverage your internal resources by reducing the recharge or deferring the recharge until a later period, then you're likely to be reviewed. This is where lawyers and accountants get very excited. Paperwork and the rest of the world sort of fall asleep. However, one of the 3 criteria to be eligible, isn't it, for the JobKeeper is to have an eligible employee. And to be an eligible employee, the employee must have provided the employer with a notification that they are willing to be nominated and fulfill the relevant criteria for that individual. So the simple way to think about it is no form, no claim. So if your employees have not provided a notification back to you, they are not an eligible employee and you cannot claim on their behalf. If you do claim on their behalf and there's a subsequent issue, then you are likely to be liable to repay some or all of the JobKeeper payments that you've received. From a practical perspective, the risks as an employer where employees are ineligible tends to sit around where you've got part-time employees because they've got another full-time job somewhere else, or casuals where they're either employed somewhere else or they don't meet the criteria. The other thing to remember is the eligibility for 16 and 17-year-olds changed. So if you did your paperwork early, you may need to revisit them to ensure that they continue to be eligible. The initial periods are retained, but the later periods they may become ineligible. This is generally where they are in full-time education elsewhere. The third element of the eligibility for JobKeeper is around wages and making minimum payments, and that's where you've got to make your minimum payment of $1,500 per fortnight per employee. Now, the consequences around PAYG withholding are clear, that you still need to withhold PAYG and remit that to the ATO in respect to those JobKeeper payments, even when people are stood down. Superannuation is very different. To the extent people are stood down, then there's no super, or it's a voluntary basis where you are just getting a subsidy for people, then there is no change to super. So understanding that mechanism and how you are dealing with that within your business is very important. Why? Because there is no deferral for superannuation. Superannuation still needs to be paid on the same basis on the quarterlies, if not prior. Otherwise, you become personally liable. In addition, just noting out there that there are a lot of deferrals for PAYG withholding and income tax, and also GST on the BAS deferrals. Directors can still be liable for PAYG withholding where that has not been paid and remitted. So whilst you might be kicking the can down the road, you need to be very careful that you have enough cash flow to be able to meet that as and when it falls due. Most of them are kicked down the road till September at the moment, but you need to be very careful. Similarly, payroll tax, there are differing states, differing rules. So if you've got a multi-state employer, it's not the same across the board. Some are fully exempt for JobKeeper, some are not, some are partial. So please bear that in mind. Then from an overarching perspective, the ATO have been very clear. They will apply Part 4A, which is the anti-avoidance legislation, and all the other penalties that they can where people fraudulently go and claim JobKeeper. So that's entering into a scheme to be able to do certain things. Overpayments are repayable with GIC, the general interest charge, and penalties, which could potentially be up to 75%. They've been very, very clear that this is not just limited to a tax offence, but can be seen to be a criminal offence. So you need to be very careful and have your documentation ready to go. The ATO do have a discretion not to claw back part of that overpayment if certain criteria are met, but it is at their discretion. There is no guidance on that yet. What this is likely to be is to where you've dealt on the correct basis, providing reliance on information provided by other parties, and therefore it would be unfair of the ATO to claw that back from you as the employer. The primary liability to repay any overpayments sits with the employer. However, Where the employer has relied on information provided by another party, i.e. an employee, then there is joint and several liability. So one of the things that the ATO look at is it reasonable for you to rely on what they've given, the information they've given to you? So if you've given a form to an employee who's a casual and has only been with you for 3 months and they sign a piece of paper and send it back and you claim for them, you know that they are not reasonable. You can't do that. However, if you've got a full-time employee who happens to have another job and they've claimed for that other job as well, then it would be reasonable for you to be able to rely on that. One of the things that the ATO look at here is who has the ultimate benefit. Have you retained, the employer retained the benefit, or has that benefit flowed to the employee? Have you made that 1,500 payment to them per fortnight? So those are some of the key risks there from a director perspective, looking at how you've actually built that. The other thing is just worth thinking about at the moment, and before I hand over to Gavin, is just trying to get you to look forwards a little bit more long term than the next 6 months. It's a hard ask, I know, but just think of this. The government is throwing a significant amount of money at the country at the moment. The country is also losing about $4 billion a week in revenue, right? So ultimately, we're going to have a large deficit. The only way that deficit is able to be recouped is from taxation. So whilst they won't tax us out of existence moving forwards, what I think we will see is a change in the focus of tax. So whether it's tax breaks being deferred, whether it's changes to GST, payroll tax, there's a whole gamut of different things that can come down the pipe at us in the future. However, you need to build your forecasts and look at your forecasts with varying different profiles, which will include the tax profile. With that in mind, I will hand over to Gavin.
Right, thank you, David, and thank you, Jason. So I will now say a few words about directors' personal liability and some strategies for managing that risk in the current environment. So there is a general duty, as most people will note, on a director to prevent insolvent trading by a company. There are defences to that, which relate to whether the director was taking part in the management of the company, given illness or some other good reason, and based on expectation and belief, where the director may have been relying upon a third party to provide information, say an external accountant or something like that. Those defences are relatively hard to make out. Now, the government has introduced a separate avenue, if you like, for a director to avoid personal liability, which is now in section 588G AAA of the Corporations Act. That effectively introduces a new safe harbour for directors to prevent insolvent trading during COVID-19. In order to avail themselves of this new safe harbour, the director must be able to show that the debt was incurred by the company during the ordinary course of the company's business. That debt was incurred during the 6-month period commencing on 25 March 2020 and before the company goes into administration or liquidation. So just as a general thing to think about, we now have an environment where there are companies that may be incurring debts that they may not be able to pay, and there are directors who know this and also know that they can avoid personal liability for those debts that are being incurred, which is a big shift from the usual environment, because that threat of personal liability for those debts incurred is a significant or powerful influencer on directors' behaviour. I'll touch on this again in a little bit. It is worth noting, as I think Jason noted earlier, that the evidential burden is on the person wishing to rely upon this new head of safe harbour. So we've also heard from Jason that there are a number of general principles that still apply in respect of directors' obligations. So the common law and statutory duties still apply, those in section 180 and following of the Corporations Act and otherwise. So what this means is, whilst a director may be able to avail themselves of avoiding personal liability for a debt incurred by a company if it is insolvent or likely to become insolvent as a result of incurring the debt, the director must still be thinking about doing things in the best interests of the company and acting with due care and diligence and in good faith. And these obligations may become relevant to a separate cause of action outside of an argument that the director should be personally liable for incurring the debt under section 588G. We've also heard from David about the ATO's position, and that is that the ATO still looks to directors to be personally liable for certain categories of debts. So as Jason said, this new provision is not a free pass. So as an example, as David noted, PAYG, the superannuation payments and now GST, can all be pursued through directors' penalty notices if they are unpaid. Now, effectively, how these notices work is if a debt in this regard is reported but unpaid, then there are options that the director can take to pay the debt or put the company into administration or liquidation if necessary to avoid personal liability. But if the debt is not reported at all, then the director needs to be able to pay the debt. Otherwise, they will have personal liability for them. So this regime is still in place and still applies. Another thing to think about in terms of personal liability is that ASIC has indicated that it will maintain enforcement activities where the public interest warrants. It's indicated that until 30 September 2020, it will afford priority to matters where there's a risk of significant consumer harm, serious breaches of the law, risk to market integrity, and also time-critical matters. So ASIC will be watching and may well take action if it considers the situation to be egregious enough. Moving on to some strategies to manage this potential personal liability if you are involved with a company that has some financial difficulties. The first thing I'd just like to look at is safe harbour. So this was introduced a couple of years ago now by the government, and it is a regime that allows a director to avoid personal liability for debts incurred whilst taking a course of action reasonably likely to lead to a better outcome than would be achieved on liquidation or administration of the company. There are some considerations around whether safe harbour is appropriate. You need to engage with a qualified person to assist in preparing reports. And given that you are comparing the current state to a hypothetical state, you need to have that documented. So having the records available is important, and working with a qualified person to prepare the different scenarios is important as well. There is an issue with safe harbour generally in that there is no definite point in time when it can be said that a company would be in safe harbour. It is a matter of doing everything you can, and then if there is an issue and if you are pursued, then you as the director would be arguing that the company was in the safe harbour and you can avail yourself of the entitlements there rather than being able to go to a register and register the fact that the company is in safe harbour. So that means that the director bears the evidential burden, as with the new safe harbour or moratorium. Then another thing to look at is voluntary administration. So this is a regime that allows a director to avoid personal liability where a company is insolvent or likely to become insolvent by having an administrator appointed, and then the administrator will determine whether the financial position of the company is such that the company should go into liquidation, that a deed of company arrangement should be entered into to deal with the creditors of the company, or whether the company should be handed back to the directors in terms of control. The deed of company arrangement process allows a director to contribute funding to then have creditors paid cents in the dollar, and thereby, if you like, cleanse the financial position of a company and then allow it to continue on or take a different direction. There are considerations with voluntary administration around having funding to fund the administration, which will either be in the company or contributed by the director itself, and also indemnities that the administrators will expect. So when we look at considering safe harbour or voluntary administration as mechanisms to manage situations where a company may be in financial difficulty, there will be different considerations, and there's no one size fits all. What we've seen is that on consideration of both of these options, sometimes directors will end up going down the voluntary administration path for particular reasons of control and being able to give them an outcome that they want in the process, or the company itself may not have the resources and the management personnel to be able to manage the safe harbour process, which requires, as I've indicated, working on a plan, implementing that plan, and having the documents available to compare how the company is travelling in relation to the plan and the expected outcome. So there are a number of things to consider, and that is all best done with your advisors. So just moving into some practical considerations for directors that will help to manage potential personal exposure. Staying informed about the company's financial position and available support is obviously a must. We've heard from David about some of the support available in relation to JobKeeper. There's also, of course, relief available from the ATO in terms of deferred payments. There's a mandatory code of conduct in relation to commercial leasing, which may be useful, and there are other strategies as well and other support available. Maximising cash flow in this period is incredibly important. Cash is king. That means looking at credit and debt arrangements, opening up the lines of communication and continuing a dialogue so that debts can be recovered and arrangements managed. The important thing is having cash coming in rather than everything paid all at once. There's also options there to, as I've indicated, to look at support available from various sources. And this ties into reducing cost base. We've heard about employees. There's a whole range of discussions there that needs to be looked at in terms of managing cost base as well as other hard costs, and also the supply chain. It is important to review commercial contracts to ensure that supply is maintained and also that services can be maintained. And there's a due diligence piece there on both ends. I've indicated that it's very important to maintain appropriate financial records, even more so in this period, so that if you want to avail yourself of any of the things that I've been speaking about, you have the records available to do so. And this ties in with speaking with insolvency practitioners and lawyers in order to guide you. And I just finally wanted to touch upon devising and implementing plans for post-COVID-19. As we're starting to come out of or see restrictions removed and starting to look to come out of this period, any plans implemented now, devised now, need to be good, not just for this period, but to move any business into the next phase so that they can survive. One concern is that with some of the government support and other support available. There will be a number of companies that can get through the COVID period, but then get to the end of the year, and when some of these support mechanisms fall away, will be unviable companies. And this ties back into, say, supply chain and commercial contracts, ensuring that ultimately you can get paid on a contract in October or November, rather than just thinking it will all be okay. So that is everything that I wanted to say. And I'll now hand over to Jason, who will handle any questions that we may have.
Thank you, Gavin. Thank you, David. We've had no questions come in as yet. We'll stay on the line for a minute or so in case there are any last-minute questions to come in. But we all thank you for your time this morning and attention. I hope you found some nuggets of information which you can take with you.
Doesn't look like we have any questions.
No questions have come through, so we might wrap it up. And again, we thank everyone for their attention this morning and wish everyone the best and stay safe in this environment. And if there's any questions, of course, that you think of later, please drop us a line. We've given our handouts and our contact details are there. So thank you again. Goodbye.
Thank you, everybody.
Thank you.